Hello, welcome to the presentation on a career in financial planning. The industry really gained attention in the 1980s, where we saw an introduction of the rollover super fund and the expansion of superannuation products. This also led to new taxes and concessions and an increase in the super guarantee obligations, followed by changes in the offering of services. Then between 2000 and 2010, the industry saw significant changes in legislations and three commissions: the Ripoll Inquiry, the Henry Tax Review, and the Cooper Review, led by the federal government, surrounding corporate collapses and financial services, new tax initiatives, and superannuation. From 2012 onwards, proposals surrounding the numeration and business operation of financial planners became law, and an overhaul in the requirements of educational and ethical standards of financial service providers, which was largely due to the 2017 Royal Commission into Misconduct of the Financial Sector. The industry saw the significant changes in legislation from the 2017 reforms to the Corporations Act 2001. These changes were aimed to increase the education, training, and ethical standards of financial advisors in the finance industry. This was initiated by the Corporations Amendment Professional Standards of Financial Advisors Act 2017. This reform meant that from the beginning of 2019, the definitions of both financial planners and advisors were now under the protection of the law, and the professionals could only use these titles who had been authorized to do so by the Financial Advisor Register, FAR. What this means is that to be able to give financial planning and advice, existing and new entrants in the profession must adhere to the compliance surrounding education and ethics, as well as obtaining valuable experience in the industry over a set period of time. For financial advisors or planners to give adequate and appropriate advice, it is essential that they are aware of factors or characteristics of markets in which investors might be interested in investing. For instance, it is essential that advisors are aware of markets that are highly cyclical or volatile, like the share market or digital currency trading, such as Bitcoin. We must understand that for some investors who are more risk adverse, these investment options are more suited for aggressive investors who are seeking long-term returns rather than conservative investors looking for short-term gains. Advisors must also have adequate understanding of how certain markets react to industry trends or economic movements, like investment options in residential or commercial property, which can be less appealing when interest rates increase for borrowing or funds to purchase such investments, and how interest rates have an effect on positive or negative gearing of investment property when interest rates decrease, and the tax implications of income received of such investments. Macroeconomic indicators which may influence the way we provide advice are inflation, deflation, exchange rates, the openness of an economy, and the general state of the market. Inflation is one of the most known economic factors, which is the rise in the price of the goods and services that we buy or produce, and we measure this by the rate of change of those prices over a set period of time, whereby deflation is a decrease of those prices. The exchange rate is the difference between one currency and another, such as the Australian dollar over the US dollar. The openness of an economy is its ability to allow entities to import and export goods and services from other markets. The general state of the market is the ability of the market which creates the supply and demand and the level of consumption and pricing within the economy. As we know, the effect that inflation can have on an economy, which includes the financial markets, can cause interest rates to rise, resulting in a reduction in share prices and lower payouts of dividends as companies experience downturns of profitability due to increase in the cost of inputs. Inflation can have an impact on the attractiveness of investment options, making them either more attractive, such as fixed interest investments, or less attractive, such as residential properties or stocks. The effect of exchange rates can have on investment options is that investors might want to seek investments in overseas markets, such as the US stock market, like NASDAQ, and the exchange rate can result in this option being less attractive as the Australian dollar can be stronger than the US dollar, but the result being a lower return on foreign investments when converting foreign currency into Australian currency. The openness of an economy, which can be measured by the level of an economy's gross domestic product. This indicator is based upon the economy's expenditure on imported goods and services from overseas markets and the level of exports that the economy can produce. This can influence the advice in investing in companies who import goods and services, as well as companies who export to other countries, as the elasticity of an economy which enables companies who profit from either importing and exporting their products can determine the level of attractiveness of investing in those companies' shares or bonds. The general state of the market can also have an influence on how we can provide advice. If the market is going through a downturn, such as a rise in interest rates and inflation, or a rise in industry trends, can determine whether we advise clients to invest in certain options that either increase their returns or reduce their losses, whilst the market bounces back up. Using industry trends can also assist in how we might advise clients in what industries to invest in, either by increasing their returns or in eliminating risk through diversification.